Hey everyone, welcome back to Corporate Decoder. Today we're diving into Citi Trends' latest filing. It's like they're trying to hide a clearance rack fire sale in boring paperwork. But don't worry, we're here to sort through it all and find out what's really going on. This report is about a big change in how Citi Trends is borrowing money. They've made an amendment or a change to their credit agreement. Think of it as their main loan agreement, which is something they use to run their business. This change happened in April of 2025. Basically, Citi Trends has made a deal, the Fourth Amendment, to change their existing credit agreement with Bank of America. It's like rewriting the rules of their financial game. This agreement lets them borrow money, and these changes will affect how much they can borrow, when they have to pay it back, and at what cost. One of the biggest changes is that they've extended when they have to pay back the loan. The original date was August of 2026, but now they don't have to pay it back until April of 2030. That gives them more time to manage their money and operations. They've also changed some of the terms or conditions and fees associated with the loan, which could mean it's cheaper or more expensive for them to borrow money depending on the specifics. The agreement still lets them borrow $75 million, and they have an Accession feature, which means they could potentially increase the amount they can borrow to $100 million under certain conditions. It's like having extra room on your credit card if you need it. The interest rates, or how much they have to pay to borrow the money, will be based on something called term SOFR. This is a benchmark interest rate. Depending on how much they're borrowing, the interest rate will be term SOFR plus either 1.5%, 1.75%, or 2%. There were 2% there with those extra percentages added on, depending on how much is available to borrow. This loan is secured by the company's inventory, accounts receivable, and related assets, but not its real estate fixtures and equipment. The agreement is backed by the things they sell, like clothes and accessories, and the money people owe them, but not by their buildings or equipment. There's also a financial rule they have to follow called a fixed charge coverage ratio, but they only have to worry about it in certain situations. It is used to make sure they can still pay the bills. This section lists all the extra documents or exhibits that are attached to the main report. Here you can find the full text of the Fourth Amendment, the document we've been talking about. If you want to read the fine print, this is where you'd go. Now, let's break this down and see what it means for Citi Trends. Extending the loan gives them more breathing room. Pushing the repayment date out to 2030 means they have more time to improve their business and generate cash without the immediate pressure of a major debt payment. The Accession feature is also a good sign. It shows that the Bank of America is willing to increase their lending if Citi Trends needs it and meets certain conditions. This flexibility can be crucial for growth or for navigating unexpected challenges. The interest rates tied to term SOFR and other benchmarks are pretty standard for these kinds of agreements. The specific rates they pay will depend on their borrowing levels and the overall economic environment. Securing the loan with inventory and accounts receivable is also typical for retailers. It allows Citi Trends to access capital using their most liquid assets, meaning the things that can be most quickly turned into cash. Overall, this new credit agreement seems like a positive move for Citi Trends. It gives them more financial flexibility and stability, which can be crucial in the competitive retail market. It indicates that banks trust them and are willing to work with them, even if it is just extending previously offered loans. However, we don't have all the details here. The filing mentions that some parts of the agreement are missing. It would be interesting to see the specifics of those covenant terms and fees that were modified. Those details could give us a better sense of the true cost and restrictions of this agreement. In conclusion, this filing tells us that Citi Trends has successfully refinanced its credit agreement, giving it more time and flexibility to manage its finances. While there are some unknowns, the overall picture seems positive for the company. Thanks for watching. If you found this breakdown helpful, please like, comment, and subscribe for more corporate deep dives.